In this short video, we're going to talk about how we might forecast future interest rates. So we have discussed in some other videos a concept called credit spreads. And a yield curve is just a picture. It's a graphical representation of the yields or the returns if you buy a bond today and you hold it to maturity. So in this case, a 10-year treasury yield bond would give you a rate of return about right there, somewhere around maybe 2.75. If you hold a 30-year bond, it's right here. Gets a little bit closer, around 2.8, 2.9. Now, the exact same yield for a AAA corporate bond is much higher, right? It looks like it's almost 2.5% higher. Why is it higher? It's higher because higher risk. And if you look at this gap, it's fairly steady and stable until you get to some short time frames, and then they begin to collapse on each other. This becomes important later on when you think about forecasting. We don't really want to forecast corporate bonds. We want to forecast treasury bonds because they're risk-free, and then apply the credit spread for a certain maturity level to ultimately forecast what kinds of returns you should get on a corporate bond. So there's a term called the forward interest rate, and this is just a rate that you can guarantee today for something that's going to happen in the future. And we start the same way all investments start. When you talk about them, talk about a 1-year investment. So when they say we're talking about a 10-year forward rate, the implication, at least in this context, is that's the return you would get on a 1-year investment 10 years from today. There is a theory called the law of one price that, again, we'll talk about in some other videos because it's very important to the corporate finance decision-making model. The law of one price basically just says two things that are exactly identical must have the exact same price. If they have the exact same price, then they should also have the exact same yield if they are identical. So in this case, a forward rate subscript 1, or a 1-year return 1 year from today, should be the yield to maturity for a bond that matures 1 year from today. Those should be equal if the law of one price is correct. But let's think about a 2-year investment strategy. Let's take a 1-year zero coupon bond, has 5.5% as its yield, and a 2-year bond is 7%. Well, you can invest in the 2-year bond, right? Get 7%. So it would be 1.07 squared. That would get you to your return that you would get for 2 years. Again, this is not my thing. It shouldn't be dollars. That should ultimately be percentages. Or you could buy a 1-year bond and get 5.5% for the first year, and then reinvest it at whatever the return is in year 2. That's F2. That will give you also a 2-year investment in a zero coupon bond. So our formula says, since the law of one price is in effect, 1.07 squared has to be equal to the product, 1.055, the yield for 1 year, multiplied by 1 plus the forward rate of the second year. If you solve for F2, you're solving for that future 1-year return. So here's the math. 1 plus F2, 1.0852%. So the forward rate is 8.52%. So the first year, interest rates will be 5.5%. The second year, it would be 8.52%. And if you kept the overall investment for the 2 years, 1.07 or 7%. So again, we can solve, since we think about risk-free and think we're also incorporating this law of one price, we can solve for these intermediate term bonds that happen at segments of the future. So how you would solve this in general, F sub n. So again, if this was F sub 5, if you wanted to know the 1-year rate 5 years from now, it'd be 1 plus the yield to maturity 5 years from now to the 5th power. Divide that by 1 plus the yield to maturity on the 4th year, right? 5 minus 1 to the 4th power. And again, subtract 1. The math gets a little bit hairy, but there is a worksheet. It's called the interest rate forecast worksheet. And in the yellow boxes here, you input what we refer to as the spot rates. The spot rates are the published rates for a certain time frame of bond. So R01 is a 1-year bond. So if you look in a newspaper, you could buy a 1-year bond for whatever this is, it's 0 coupon, and get 5%. The 2-year, you could get 6%. So if you bought it today, times 0, held it to time 2, you'd earn 6%. R03 is a 3-year bond, R04 is 4. So this is what we would refer to as the yield curve of this particular 0 coupon bond. Now this worksheet will help us calculate a lot of things, but the first thing it will help us do is calculate the 1-year rates. The first number here is the spot rate because that's this year, but these other numbers, these are all 1-year rates sometime in the future. These are forward rates. So we're predicting here that the interest rate next year will be 7%, the year after that 6%, the year after that 5%. So we can do this with, in this case, the book gives us some numbers for the Canadian government. What are their bonds? So we have 1 through 10. If you put in their yields here, again, it's 1 plus the yield. So it'd be 1.0051 is 0.51%. Put those yield curves here again. It will help us calculate these 1-year forward rates. So the year 2 would be 0.43% is the return we'd expect to get in 2 years. And the 10th year, right, F10 down here, this is the number you would expect to get at 2.72 is what you would expect to get going out there that 10th year. This spreadsheet also lets us look at some wider things, some other types of bonds. So it can also help us look at longer term bonds. So what's the expected return of a 5-year bond in 3 years? If we take that former yield curve, now we're looking for 5-year rates. So if you look, this first bond is 0.5. That is the spot rate. If you would buy it today, sell it in 5 years, that's what the return would be today. But out here, if you look, this is F49. So in 4 years, you're going to buy a 5-year bond. The return on that bond would be 2.024%. So it is possible to forecast these 0 coupon, in quotes, risk-free bonds, because other than that, they're all the same. So the law of one price allows us to calculate an equivalent return for both sides of an equation. So what would we want to do with corporate bonds? If you think about these forward rates as being a break-even rate, so to speak, and since people do care about risk, the spot rate in the future is going to be this forward rate plus some risk premium. What is the risk premium? The risk premium are these yield spreads. So if you know on average the yield spread between a AAA and in fact, let's go back here. Let's say if you knew that the average yield spread between a AAA rated bond and this 5-year bond out here going out to 10 years, if you knew that that was roughly 3%, 3% plus 2.5 or 5.285%, that would be the yield you would expect on that 5-year corporate bond. So you add the yield spread to the time frame that you're talking about, and that will help you predict future interest rates. Now, of course, we know that predictions, by their very nature, are incorrect. They're wrong. They have error. So we have to make adjustments over time to keep fine-tuning our forecast of what we think interest rates will be in the future. And of course, we can make preparations for hedging risk or changing the returns that we receive by making some type of investment decision. That's not really part of this class, but we can make those adjustments in the future. Look forward to seeing you in the next video.